Welcome to the Deep Dive, your ultimate shortcut to staying well-informed without getting totally buried in information.
That's the goal.
Today, we're plunging into the recent Q1 FY26 earnings call from HDFC Bank Limited, and our mission for you, really, is to cut through all that corporate jargon.
Yep, get straight to the point.
Deliver the most impactful nuggets of knowledge so you can grasp the critical strategic shifts and the future outlook for this pretty significant financial player.
Exactly. We've meticulously synthesized all the vital information, distilling the key financial performance, management insights, and the broader economic context. The idea is to give you a clear, concise, and hopefully actionable understanding of what's truly driving the narrative for HDFC Bank right now.
Okay, so to really grasp this evolution, let's first anchor ourselves in the latest results. Q1 FY26. After a period of, deliberate strategic recalibration, HDFC Bank is definitely showing early signs, but significant signs, of reaccelerating.
Yes, they are.
They reported a healthy 16% year-on-year growth in average deposits. It's a powerful indicator, right? Continued market share gains.
Absolutely. And that deposit growth is crucial because it directly addresses a prior strategic objective. See, while average advances, which for a bank just means their loan book or assets under management, were intentionally slowed last year.
Right, down to about 7%.
Yeah, around 7%. That was part of a crucial post-merger strategic goal. But now they've seen a notable improvement to 8% in this last quarter, Q1 FY26. That little upward tick, it signals a strategic pivot.
And beyond the core numbers, there's even more positive news for shareholders, stuff that speaks volumes about management confidence.
Oh, yeah.
The bank announced an interim dividend, 5 rupees per share, and for the very first time ever, recommended a 1-for-1 bonus share issuance.
Wow, 1-for-1, that's significant.
It really is. This isn't just a routine payout, it's a powerful signal. A 1-for-1 bonus, especially the first time, it hints at deep confidence in sustained future earnings.
And their ability to generate capital internally, perhaps, without needing to hold on to it so tightly.
Exactly. It suggests they've passed a critical inflection point. Maybe capital constraints aren't the primary concern anymore. Could be setting a new benchmark.
Interesting angle.
Okay, let's unpack this strategic U-turn then. For the past year, HDFC Bank intentionally slowed its lending growth. What exactly was the driving force behind that? And maybe more importantly, what's fundamentally changing now that lets them shift gears?
Right. So the core reason was a very specific strategic objective to significantly bring down their credit deposit ratio, the CD ratio.
Okay.
This ratio, it compares a bank's total loans to its total deposits. And immediately post-merger, it was, unsustainably high at 110%.
110.
Yeah. Reducing it to around 95% was critical. For liquidity, reducing reliance on expensive wholesale funding, ensuring regulatory compliance, you know the drill.
So they had to slow down loans while really pushing for deposits.
Precisely. And they've largely achieved that crucial objective now. It puts them in a much, much healthier position.
So if the CD ratio was the bottleneck, and they pretty much cleared it, what does this truly mean going forward? We saw that 8% loan growth this quarter. Is that just a blip, or is this genuinely the start of something bigger, more aggressive?
Oh, it's absolutely the beginning of something bigger. Management was explicit about this on the call.
They were.
Yeah. They guided for loan growth to continue improving from here. They expect to grow in line with the overall banking system in FY26.
Okay, matching the market.
And then even more notably, to outperform the system in FY27.
Okay, so that's the real acceleration.
That's the plan. This pivotal shift allows them to be far more aggressive in leveraging their now improved liquidity. It's a fundamental change from consolidation back to expansion.
Okay, here's where it gets really interesting for me. What are the broader macro factors and the specific market segments that are going to trigger and sustain this growth?
Yeah.
Especially when the whole sector kind of saw a slowdown. What gives them the confidence now?
Well, there are several significant tailwinds at play, giving them a pretty robust backdrop. Globally, things are still volatile, sure.
Understatement, maybe?
Maybe. But India is seen as relatively better placed, stable macro environment, comparatively speaking.
Right.
We're looking at sustained GDP growth supported by improved domestic factors, things like normal monsoons, recent income tax cuts, benign food inflation.
All helping the consumer.
Exactly. All positioned to boost consumption demand, particularly with the festive season coming up.
And where does the bank see specific opportunities?
They highlighted distinct pockets, healthy demand coming from the rural side, apparently, urban consumption picking up, especially in premium and unsecured segments, and buoyancy in MSMEs, the micro, small, and medium enterprises, despite some of those global tariff uncertainties you hear about.
Even mortgages. That space is incredibly competitive.
Even mortgages. They believe they can pick up significant volumes there. They're leveraging their, huge branch network, strong customer relationships, their ability to cross-sell. That deep distribution capability lets them get into markets others might struggle with.
Okay, so they've shifted strategy towards growth. But we also need to look at profitability. The call mentioned some fluctuations in net interest margins, which management acknowledged. Can you walk us through why that's happening and what's the outlook?
Yeah, margins are always key. What's fascinating here is the lead lag impact of policy rate changes. It's pretty central to how bank profitability works.
Lead lag. Explain that a bit.
Sure. So roughly 70% of the bank's asset side, their loans, is floating rate. It reprices relatively quickly when benchmark interest rates change.
Okay, so loan income adjusts fast.
Right. But their liability side, mostly deposits, is more fixed in nature. It takes much longer, typically 12 to 18 months for most deposits, to fully factor in those rate changes.
So deposit costs adjust slowly.
Exactly. And this creates a headwind, like a drag, when the rate cycle is trending downwards like it has been. That leads to those quarterly fluctuations. It's like steering a giant ship. You turn the wheel, but it takes time to respond.
So that 50 basis point rate cut we saw back in June,
Yeah.
that isn't fully baked into the deposit costs yet. And that's still pressing down on current margins.
That's precisely right. The full impact of that June cut won't be seen for another, say, 1 to 3 months as their fixed rate liabilities gradually reprice lower.
So when can we expect things to stabilize or maybe even tick up?
Well, management expects margins to stabilize over time. And logically, if we don't see any more rate cuts soon, we might hit a trough in the coming months. After that, they should start to pick up again as the benefits from repricing those liabilities finally catch up. So short-term volatility, maybe, but the underlying trend points towards stabilization.
That lead lag effect is definitely tricky. But as HDFC looks to stabilize profits and ramp up lending, funding becomes critical. Which brings us to deposits, specifically CASA.
Yes, CASA, current account savings account.
How is their strategy evolving there? Especially now that the immediate post-merger liquidity crunch seems mostly handled.
Good question. Because post-merger, the absolute priority was just getting any deposits in the door to fix that CD ratio.
Right, quantity over quality initially.
Kind of, less emphasis on the nuances of low-cost CASA. And CASA is, the lifeblood for bank profitability. It's the cheapest, most stable funding source because customers earn little or no interest compared to term deposits.
So what's the shift now?
Now, with liquidity better and the CD ratio managed, the strategic direction has clearly shifted. The focus is firmly on cross-selling more products, enhancing customer experience, basically trying to get back some of the mojo, as they might say, on the low-cost deposit franchise.
Reinvigorate CASA.
Exactly. It won't happen overnight, they acknowledge that, but it's a clear strategic pivot. They did note, though, that their target segment, middle and upper middle income, tends to optimize returns more actively.
Meaning they're quicker to move money out of CASA for better yields elsewhere.
Potentially, yeah. It makes CASA acquisition more dynamic, more competitive, requires a more sophisticated approach than just opening branches.
Makes sense. Okay, another crucial aspect for any bank, especially one pushing growth.
Yeah.
Asset quality. How's HDFC Bank positioned there? Is it strong enough to support this expansion?
Asset quality remains, exceptionally healthy. It's frankly one of their main USPs, their unique selling points.
Really? That's strong.
Yeah. If you exclude the agricultural portfolio, which is naturally cyclical, you see slight blips in June and December due to seasons. The quality across the rest of the book is extremely benign.
Got a number for that.
For the retail segment, excluding agriculture, their gross non-performing assets, GNPA, stands at a remarkably low and stable 82 basis points.
0.82%.
Wow. And it's been consistent year on year. This isn't just comforting, it's a crucial strategic enabler.
How so?
In a competitive, often cyclical banking world, this lets HDFC pursue growth, maybe even in higher yielding segments or during downturns, without taking on undue risk. It's a buffer, a real differentiator that gives them flexibility for this growth phase.
And we saw that additional contingent provision this quarter, 1,700 crores, which is, 17 billion rupees? A big number?
It is a significant number.
Why do that if asset quality is so strong?
Is there a risk some might see that as overly conservative, maybe hitting short-term profits?
It's an important detail, and yeah, it speaks to their prudent risk management. They stressed this provision is not due to any specific problems they're seeing right now.
No specific pain points.
No. Instead, it's proactive. It comes from running various sophisticated probability models across their different loan pools.
So, data analytics predicting potential future risks.
Essentially, yes. Anticipating and provisioning for risks even if they aren't visible yet. The aim is to build even greater resilience, maintain a robust reserving position. It increases their total contingent provision to 57 basis points of the loan portfolio. So it hits profits now, but protects them later.
Exactly. Non-negotiable for long-term stability. A hallmark of conservative, well-managed banking, being prepared.
Okay, shifting gears slightly to operations, they added around 4,000 employees this quarter. What does that tell us about their operational strategy and investment? And what about the cost-to-income ratio?
Right, 4,000 people. That primarily stems from fully manning the large number of new branches they opened back in Q4 of last year.
Ah, catching up on staffing those.
Correct. Plus, they've added staff to critical tech teams and, importantly, bolstered their sales force both in branches and general sales roles.
Aligns with the growth push.
It aligns perfectly with their stated long-term vision. More customer-facing, revenue-generating employees with back-end functions hopefully seeing relatively smaller increases over time as they leverage tech.
And costs. Cost income is around 42% now.
Around 42%, yeah. Managing that remains a priority, despite these big investments in growth. But, it will naturally see quarterly fluctuations.
Because of marketing spending, festival pushes, that kind of thing.
Precisely. Those costs often get concentrated in specific quarters. It's an investment in future growth, so you expect some variability there.
So let's try and tie this all together. What does this mean for you, our listener? Whether you're tracking the sector, maybe thinking about investing, or just want to understand how a banking giant operates.
Well, if you connect the dots, HDFC Bank is very deliberately moving. They're shifting from that necessary post-merger integration phase where slowing down was essential to a very focused, accelerated growth path. And their exceptionally strong asset quality acts as a significant safety net in what's still a competitive market.
Plus the dividend and that unprecedented bonus share.
Yes, those are powerful signals. Management confidence, focus on shareholder value. They aren't just talking growth. They're laying the groundwork, showing tangible steps.
Are there any other critical areas that investors or just keen observers should keep a close eye on as the story unfolds? Any potential headwinds?
One area to continuously monitor is definitely priority sector lending, or PSL.
The regulatory mandates.
Exactly. Post-merger, with HDFC Limited's much larger loan base added in, their achievement rates for these PSL targets have naturally come down.
Makes sense. Bigger base, harder to hit percentage target.
Right. And while they actively manage this buying and selling PSLCs, those tradable certificates.
Like carbon credits, but for lending targets?
Sort of, yeah. It allows banks to meet targets indirectly. But finding enough PSLCs for certain niche segments, like small and marginal farmers or specific micro segments, that remains a persistent challenge. There just isn't enough supply in the market for those specific types.
So it's a compliance headache.
It's a perpetual compliance challenge, yes. And it can even impact their ability to grow freely if they feel constrained by these targets. It's a regulatory tightrope.
And management doesn't expect regulators to give them any slack on that.
No, they don't anticipate any immediate changes providing leeway. It's a challenge they'll likely have to innovate around internally.
Okay. And now for our segment. This is not financial advice.
The disclaimer part.
Absolutely. Where we explore outrageous but plausible trade ideas stemming from our deep dive. Remember, this is purely for intellectual exercise. Do not act on this without professional financial advice.
Got it. So given HDFC Bank's really clear articulation of this impending growth acceleration FY26 and especially FY27, and you couple that with their rock-solid asset quality and the fact that net interest margins should trough and stabilize soon.
Okay, where are you going with this?
A compelling, though definitely aggressive play could be a long-dated, out-of-the-money call option strategy.
Long-dated calls. Okay, define outrageous.
The outrageous part is the time horizon looking out quite far, and the ambitious strike price you'd choose for the call option, betting on significant upside.
But why plausible?
It becomes plausible when you consider the company's stated goal, significantly outperform system loan growth in FY27, and if those strategic CASA initiatives start yielding real results.
Margin improvement potential, too.
Exactly. That could lead to a significant multiple expansion for the stock once the whole margin narrative settles down and the market fully buys into their renewed growth engine.
So betting on methodical execution of a clear plan.
Pretty much. Betting on the execution of a roadmap that prioritizes long-term market dominance over maybe some short-term quarterly noise.
Interesting. Okay, that wraps up our deep dive into HDFC Bank Limited's Q1 FY26 earnings. As we reflect, what really stands out for me, and hopefully for you, is this methodical, almost understated approach HDFC took post-merger.
Very deliberate.
Yeah. Sacrificing maybe some short-term optics, managing that CD ratio first, and now setting the stage for deliberate, high-quality growth. It feels like a play for long-term dominance. Fascinating to watch.
I agree. The bank presented a really compelling narrative. Strategic execution, moving from consolidation to acceleration, all built on that impressive asset quality and a clear vision for fixing the deposit mix. It's patient, strategic banking in action. And just a reminder, the information we've discussed is for general informational purposes only. It does not constitute financial or investment advice.
Always consult with a qualified professional before making any investment decisions. Seriously. We do love hearing from you, though. If you have thoughts or questions about this deep dive or ideas for future topics, please feel free to reach out. Thank you for tuning in to The Deep Dive.